difficulties. Okay, welcome everybody. I appreciate everybody online, quite a few people online tonight, so welcome, appreciate that. I am Kelly Slott, the owner and CEO of California Wealth Advisors. So tonight we have Mr. Saul Doherty speaking with us, one of my favorite people in the world. I spent a lot of time with Saul, so he has a great story to tell with his Cottonwood investment portfolios, which are wonderful, love them. So before I jump into everything, we do have our flag, our California Wealth Advisors flag. Go to my website, California Wealth Advisors, and you'll see me recently at Switzerland, France, Germany, and Amsterdam, holding my flag, taking pictures all over the world. I have 3 of these. I give them to clients to take pictures of themselves all over the world. So we have a whole smorgasbord of people, Singapore, all sorts of places people have gone. So by all means, if you're traveling somewhere, ask us, and your client, ask us for the flag, and we'll send you ones to take pictures wherever you're going in the world. So thank you, Saul, again for coming tonight. Really am excited about tonight. I love real estate. Cottonwood is a real estate program, apartment program, great program. So with that, we will jump into the slides. Okay, perfect. Yes, we do have Saul. I'll introduce him in a minute. Okay, many of you found me through the radio show, KNX 1070. So welcome to all of the new folks there. I love my radio show. It's so fun to do. I have so much fun with my co-host, Dave. We really enjoy doing it. I hope that comes through in the radio show and the excitement that we have and the knowledge that we try and give everybody out there to help them with their overall financial houses. So by all means, listen to my radio show. I do have all of my previous radio shows on my website, CaliforniaWealthAdvisors.com. Go to the radio tab and you can listen to 4.5 years of radio shows there. And David was very nice in titling for me each show about kind of what we talk about in each show, because every show is a little different. So by all means, go to my radio show. It's a lot of fun. Plays on Saturday mornings from 7 to 8 a.m. I did write a book as well, The Great Retirement Mystery. Wait a minute, here it is right here, The Great Retirement Mystery. This is true for everyone because I have in here how to avoid the 6 biggest blunders. That's true for anyone and everyone. I want you to avoid blunders that I see people making all the time out there. What's one of the blunders? Well, who are you listening to? Are you listening to your brother's best friends, whoever? Do they really know about your financial house? Probably not. So let's make sure you're listening to qualified people that know financial advising, that know how to bring financial help to you, directly to you. Okay, key components to investing. You need to have a plan. It's got to start there. What's your plan? What is going to be appropriate for you? Have a plan designed specifically for you. And that's different for everyone. Every client that comes to see me is different. So what is specific to you that you need in your portfolio? Maybe you need income created. Maybe you need legacy passing you're concerned about. Lots of different things we can do. Maybe you need tax write-offs. We have a lot of clients these days that are selling their business. They need tax write-offs. They're getting huge checks from the sale of their business. They're very blessed with that, but they've got a lot of taxes they've got to pay. So what are you doing to mitigate some of that? So have a plan that's designed and specific to you. And the way I do it is starting with diversification. What is your correct diversification? And I do that through my master proprietary process. M is the market, A is alternatives, S is safe money. So when I design portfolios, your investment dollars for that, it tends to bring peace of mind and comfort, especially when you're pre-retirement or in retirement. So the master proprietary process, here's a diagram of that. So actually M is the market, stocks, bonds, and mutual funds. And I did make it red for a reason. Markets go up and down. So if you're willing to take that risk, great, no problem. I like the market. I can create income. I can create growth. This can be great for that. But there's risk, right? And a lot of times people get to retirement and they don't want to have so much risk in their portfolio. They don't have 20, 30 years ahead of them. If the market goes down and their $1 million turns into 500,000, that's a problem because I'm trying to create income off of $1 million and now I only have a 500,000. That can be a problem. So let's make sure you've got the correct diversification in your portfolio. Again, what's specific to you. And then I look at the alternative space. That's what Saul's going to talk about tonight in the apartment programs he represents. I love the apartment programs. I love real estate. I love private placements, oil and gas programs for write-offs. I use those for people that are selling highly appreciated assets. We do a lot of 1031 exchanges as well. But anything that does not travel with the market is in the A part. That's the alternative part. And then the safe section, S part there, down there, that's cash, CDs, fixed annuities, life insurance, long-term care, fixed index annuities as well. Anything that does not go down in value, backed by either the bank, the FDIC, or insurance companies. So a lot of times people come to me and they say, hey, I want part of my portfolio to have income guaranteed for my life and my spouse's life. And I can actually do that. I can't say that about the M part, and I can't say that about the A part as well, as far as the guarantees go. So yes, I can say it's safe. I can say it's guaranteed, again, backed by insurance companies. So when I do all three of these for clients, they do tend to be more comfortable with looking into retirement for themselves. And I like people to come to me before retirement. So before retirement, come to me. We'll look at what you have. We'll create a strategy and a plan for you, and then we'll implement that once you retire. And even if you're in retirement, we can adjust these things for you. So even if you're all in the market right now and you've retired and that's where your 401k is, it's okay. We can move things around. We can adjust to make it more beneficial to you. So I love my master proprietary process. I think it works really well for clients. Okay, I want to talk about my private client process because, again, it is important, I think, to look at your entire financial house, not just your investment dollars, but your entire financial house. So with that, I'm going to have Hannah. Thank you. Oh, by the way, we've got Hannah and Carter and Christian here tonight. Thank you guys for being here. Yeah, they're in the room. Thank you. I so appreciate them being here and helping. It's couldn't do this without them, that's for sure. So thank you, Carter. That's fine. I think we're good there. Okay. All right. Let me talk about my private client process. So I position myself as your financial director in your overall financial house. And your financial house is not just your investment dollars, but it is an important part, certainly. So here's your investment dollars. I'm not going to talk about that right now. We're going to talk about that. Well, that's part of my master proprietary process, and Saul's going to talk about investment dollars too. But what is left in your entire financial house? Well, you have risk. What risk do you have in your overall financial house? So what am I talking about here? Well, taxes, especially if you've sold a business, you sold any highly appreciated asset, maybe a stock. I have a client that bought $100,000 of Apple stock 25 years ago. It's worth $3 million today. She just sold $1 million of it last year. We needed to do something to mitigate taxes she was going to have to pay there, and so we did. So taxes, I think, is a risk because once you write that check to the IRS, are you ever going to get it back? Probably not. So let's make sure you're not giving all of your profits to the government in taxes. So taxes, I think, is a risk. We're also going to look at your property and casualty, your insurances. What insurance do you have? Do you have the right umbrella policies? When are you going to take Social Security? Oops, social, if I can spell, Social Security. That says Social Security. So taking it is very important. That's a risk in your portfolio too, because if you take it at 62 versus 70, that's 132% difference. That's a big number. So we want to make sure we're taking Social Security at the right time for you. So there's lots of things at risk in your overall financial house, and have you addressed them? I think inflation actually is another one. Have you addressed inflation in your overall financial house? Because inflation will eat away at your investment dollars. And if you don't do something to mitigate that, your dollars are going down over time. So let's make sure we're looking at the risk side of your investment portfolio. Then we're going to look at estate planning. So do you have estate planning documents? Do you have a trust? And a lot of clients come to me and they say, yeah, I have a trust. And I say, okay, well, when did you do it? Oh, 20 years ago. Well, 20 years ago, they didn't have kids yet. They weren't married. They weren't divorced. Whatever happened in their lives probably hasn't happened yet. So the trust is very old. They need to update it. I would say you need to update your trust probably every couple of years. And I am going to have next week a seminar with my estate planning attorney and my tax CPA as well. So by all means, listen to that. That's going to be in person or Zoom as well. But I want to make sure you have the correct estate planning documents and they're up to date. I want to make sure you have a power of attorney. That's very important. I want to make sure you have a medical directive. These are all really important. And sometimes I see trust documents that don't have these in there. I have a very close personal friend of mine. He's selling his business for about $200 million. He doesn't need me to manage his money, but he came to me recently and he said, you know, I need you to do this for me because if I died tomorrow, my 5 children would never know what to do. They don't know where my trust documents are. If I got sick and I was in the hospital, they don't know where the power of attorney or the medical directive is. So I might not need to do this for you necessarily, although usually I do, but maybe these other things are going to be very important to you. The last thing I do here is the vault. That's where I put all of your important documents. I put your passport. I have many clients that love to travel. I love to travel too. I put your passport in your vault so we have a copy of it. I had a client a number of years ago, she went to Spain, she got pickpocketed. She lost her passport. It took her 2 weeks to get out of Spain because of all the documentation she had to go through. If I had had her passport at the time, I could have just sent her a picture of it. Believe me, it would have saved her a lot of headache. So your passports, your driver's license, we put in here, your trust documents, your investment statements go over here. So we know where all of those are as well. Your bank statements can go in there. A lot of things can go in your vault to make sure you're covered with if anything should happen to you, and your beneficiaries, your heirs will know where to go. So it doesn't matter if you have $1 million or $100 million. If you haven't taken care of all of these things, your entire financial house could be at risk. And I don't want to see that. I want to make sure you're covered with all of that. So with that, oh, by the way, I recorded this on my website. It's under private client process on California Wealth Advisors. If you just click on that, I go into much more detail of this. So by all means, go ahead and have a look at that. Thank you, Carter. And take that away. Perfect. All right, let's introduce Saul. All right, we have Saul. Saul, you ready?
Yep.
Okay, he's ready. Okay. Okay, so Saul Doherty serves as the Senior Vice President of Capital Markets for Cottonwood Communities. He's been there for 11 years. He has 27 years of marketing and business development experience, so he's very knowledgeable at what he's talking about here. He lives in San Diego with his wife, Allison, and 3 children. Yeah. Saul, I have played much golf with Saul. We've had a lot of fun out there. He loves snowboarding, and I would say one of the fun things about Saul is he loves making Christmas cards. And maybe he'll talk about them tonight, but last year's was the Tiger King.
That's right.
So the Tiger King, and he dressed his whole family as the Tiger King for characters, I guess you could say. The year before was Game of Thrones, right? Yeah. Game of Thrones. He's very creative. He and his family, I give him a lot of credit. A lot of fun. So Saul, thank you so much for being here. If you have questions, please type them in the chat box online. Hannah's monitoring those for us. And then people in the room, write those down for us, and we'll ask Saul maybe towards the end. We'll get some questions answered. Okay.
Thanks.
Thank you, Saul.
Yeah, appreciate that. As I go through these slides here, we have some things right here that are just a little message from our attorneys. They basically say everything has risk, right? And evaluating that risk and what's appropriate for you is really what California Wealth Advisors and Kelly will help you guys do individually. I'm going to take you through what we do, which is very specific. It's apartments. So Cottonwood has been around since 2004, 21 years, right? We've done a really long history of providing our investors, growth and income, right? Today, we manage about $3 billion, just under that, $2.9 billion worth of apartments, assets. It's all multifamily. So when I say apartments, we're thinking of 100, 200, 300 unit apartment buildings, the Class A stuff, where people are living there, and almost everybody has lived in an apartment in their life, right? I mean, some point in college, or right when you didn't go to college, you're living in apartments. And many times when I'm doing these presentations, I always ask people, did anybody ever have your rent go down? I usually get a little chuckle, right?
Wow.
The reality is that we all touch an apartment in some way or another. We've either lived in one in our lives, maybe you've owned one, maybe your kids live in one, maybe your grandkids. Today, you're seeing more of that living than you ever have before. And so we specialize in operating those, in building those, in buying those, and financing those, right? It's kind of every aspect in there. In fact, we're vertically integrated. What that means is I've got a property management company. I've got a development company that helps build them. I've got a resident indemnity company where if you're a renter in one of our assets, you have to get renter's insurance. If you don't want to pay State Farm $40 a month to insure your couch and TV, you can pay $9 a month just to ensure that maybe you start a kitchen fire, you don't have to pay the deductible on our PNC policy. We'll cover you for that, right? And when we say we're vertically integrated, those are all the operating entities. Almost every real estate group has some of those. For ours, it's very unique because the REIT, the entity that you invest in, is actually who owns them. So the fees that those companies get, the revenues that those companies generate, are actually embedded inside the REIT and are shared with all our investors. And depending upon how you invest with us, you get a piece of that. So it aligns us as a group with our investors really well. So my CEO, a guy named Dan Schaefer, right? And you'll see on here, it aligns our interests. Between him and the other executives, they own about 10% of the common equity. It's the bulk of their net worth. It's just about $100 million, right? They'll tell you we're long-term greedy. We're going to make decisions that are going to make money. We want to do that, but we're going to make it with everybody so that we're making money together. And we hope that over years and years, you're going to keep doing business with us. You're going to keep wanting to be invested with us. It used to be that we did programs and then we'd close them out and then we'd open them up, right? This is kind of what my executive team looks like. Last guy came with us it's really about 12 years now that he came on. So we've got a really cohesive team that's been here for a long time. I've been here for 11 years. Nothing's broken. People aren't leaving and coming and going. This is a group that knows each other really well and they operate really well. And if you look at our history of different funds, things where we opened up a fund, we raised capital, we bought real estate, and then we created liquidity for investors. If you look on what is my right-hand side of the column where it says average investor rate of return, this is how we did for our investors. When we created the liquidity for them, the lowest return was 11.7. That was when somebody bought in, that was the average, right? We got a 12.8, we have a 12.3. These are kind of diversified portfolios. The 17% at the bottom was the development deal that we did for investors, right? Where they were just investing. Those were kind of siloed. Each way that somebody was investing was either an operating property or a development property. And we did really well over the time. But what we're doing today is we've kind of merged all this together and it's in one portfolio. So today, this is what Cottonwood manages. This is the portfolio. When I say us, this is what I'm talking about. Now you can see this has about 2.3 billion. We manage just about 3 billion total. So there are some other properties that we manage for outside investors, but this is the only entity that we have that you can invest in. Those other properties that we manage, the fees we generate from managing those go to the bottom line of this fund. That's part of that vertical integration that I had shared with you, right? And where I'm going with this is that this is the entity we have, right? So it's 2.3 billion in total assets. It's about 37 different investments, about just over 9,000 apartment units, so doors of people living in there, right? My average rent is $1,732. Depending upon where you're viewing this from, that may sound really low. We're in the Sun Belt. If you look in kind of the upper right-hand corner, you can see the geographic diversity that we have. If you drew a smile across the US, right? Kind of a Cheshire cat smile. So it was really singing up and down. That's where our assets are. And typically that's where you're seeing job and population growth go today. So 1732 is an average rent. That's pretty good for most of those markets. That sounds cheap here in California, but that is across the country. We're 94.4% occupied. For those of you guys that don't know real estate, that's spot on economic occupancy. I don't want to be 100% occupied. If I'm 100% occupied, it means my rents are too low. We want somewhere between kind of above 90, 93 to 96 is really where you want to see on that stuff. So we love 94.4. That means we're priced out well, that supplies are in the right spot for us, and that we have ability to grow those rents, which is how we generate growth in revenue and income for you. Look at the bottom here, I'm 53.7% levered at a property level. That's a pretty reasonable leverage for us. Now we've been lower. We've had it down as low as in the 40s. And we like to get that way. We're going to drive some of this leverage down a little bit because leverage in real estate can be your best friend. It can also be the hardest thing to deal with. Depends on the way the markets are going, right? When things are going up, if you're highly levered, it kind of juices those returns. If things are on a correction, which we see in cycles in the country, right? Real estate have their own cycles to them. They usually last about 8 to 12 years long, right? Then those can be something that it's harder for you on the downside. So the goal is to have leverage so you're using it in the right place, to have the right type of leverage so that it doesn't cause you too much risk, but that it's in place there so that you can get the right returns and the right type of income that we need to see from it. So for us, if you look over to the right again on the bottom, I'm going to show you the graph of how we invest. About 82% of the portfolio is operating apartments where there's somebody living there today paying rent, right? It's what you think about when I say apartments. Real estate related in the middle, it's about 10.4 today. That's us lending money to developers so that they can actually build an apartment. So different developer that does apartments, they're going to get money from a bank to be able to do the construction costs. Banks today are loaning a lot less than they used to in that space. They're taking very little risk. I'll talk a little bit more about that in a second. We loan money to those developers and we get returns back from it. Used to be 11 to 13. Today, we're getting 14 to 16% coupons on those type of loans. And the total return gets even a little higher, somewhere in the 18 to 20%. That's actually really high returns for that type of investment. That's what you expect in the bottom part here, which is development, where you're building it from the ground up. So development is when we actually literally are getting the dirt, getting in all the easements in place, and building that asset from the ground to the top. And then we're going to own it, and we're going to lease it out, and we're going to operate it for years. And the reality is that is the highest return expectation. You don't get into it unless we can model out that we're going to get a 20% return or higher, but it's the most risky. Things happen in development. People always say, what could happen? We've seen everything under the sun. The reality is we're really good at that. And we do all three of these aspects, and we can shift around how we invest in the real estate market based off what's happening. And I'll take you through a little bit of what's happened over the last couple of years and some of the cycles that we've seen in real estate. It's key that you can shift around. It's also key that because we have experience in each one of these, if something happens, we have the expertise to be able to fix that. Like we've loaned somebody money once, only one time in our whole 21 years of doing that, where they couldn't finish the project and we took it over and finished the development side of that, right? That takes a different type of expertise, but we do all that stuff. So we're vertically integrated. We share those revenues with our investors. We do all aspects of multifamily that there is, and we're going to keep doing this. We've been doing it for 21 years. So first off, let's talk a little bit about our philosophy. Okay. So the markets that we're looking at, I kind of explained to you, are in like the Sun Belt, right? So if you're going here, it's where, job and population is going to, it's where you're seeing kind of renters and more masses on that side of it. And we want to see infill sites. An infill site means that you can't build something right next to it without seeing some kind of cost to getting into that, right? There's not a big dirt patch right next to you that somebody could just build something and create your competition with it. So as you look at this graph here, this is really where you're seeing job and population growth in the US. The orange dots are where our assets are, and the darker the blue means the more people you're seeing moving to that space. And so as you look at where we are on this map, you're seeing those are the dark spots. You're seeing the migration of people move into those, right? And that's what you want, right? Because you want to have people coming into those areas where you need housing and they're going to be able to rent. We also look at what's the GDP, meaning what kind of production is coming out of those areas. Salt Lake City, kind of Utah right there, is actually the fastest growing segment of the US for GDP, meaning they have more business going out of there, have more production starting out of there. They have more stuff being developed out of that market than anywhere. And we had a big influence of trying to gain more assets in that market. Most of that we had to build into because it was so difficult to buy. We happen to be based in Salt Lake City, for full disclosure. We know that market, we love it really well. And it's been growing phenomenally over the last years. We expect for it to grow throughout as we move through this. But this is where we want to see, right? You want to get in the path of growth so that as you see people move into those areas, they're occupying my apartments, they're renting them out. We're going to get a reasonable rent growth. We strive for 2.5% to 3% rent growth. We've seen things all over the sun, but that's what we're looking for. And what we focus on is typically what's called a Class A apartment. Something newer, a little bit nicer, a little younger in age from when it was built. And the reason why is that the tenants that live in a Class A apartment typically have a little bit higher quality of a job. They may have a little bit higher education in it. They're probably, a couple years into that career, and they can weather economic downturns because everybody does well when the market's doing fantastic. I don't care if it's stocks or real estate or whatever it is, right? The term is all boats rise in a rising tide. It's when things have a trouble, when times are hard, that you really show how something does well. And as we look at this, we look at the quality of a job, and I'm not saying it's a bad job. In fact, the backbone of America is the workforce labor that we have. All of us have family and friends that know and love that we need in that. They are affected much more in economic downturns than people on here. If you look at the top, are these kind of colors coded, you got orange and blue, right? The orange side, information technology, financial activities, business, professional services, those tend to weather those economic hardships a little bit better. Whereas you look on the blue side, right, you're seeing hospitality, manufacturing, government, construction. These things, when we're having economic hard times, tend to lose their jobs or have more unemployment. And if you look at the graph above, the gold bars 1, 2, and 3, if you look at it, it's the 2001 dot-com bubble burst. We got the great financial crisis in 2008, and we have COVID in 2020, right? And as you look at the brown kind of job frame here, that's the unemployment rates for our orange Bob. The dotted line is the unemployment rates for the blue jobs. And every time you get into one of these segments, you see that unemployment rate starts sooner, gets deeper, and lasts longer. Well, what happens? They just can't afford some of those rents that you're having, right? People you either lower your rents, or they move home with mom and dad, or they double up in different things, but people make decisions. And when you have people that are employed with a quality of job of what we're looking for in Class A, they tend to weather that much better. It also costs less to operate those type of properties, right? If I built something in the last 5 years, I don't have to put a new roof on it. I don't have to put a new parking lot in place. My AC units and everything else tend to be pretty good. Sure, of course, you put paint and new fixtures on every so often pretty regularly. That's just upkeep. But I'm talking about major infrastructure in there. And so the profit margins on a Class A property is much nicer. You demand a higher rent, you get a higher quality tenant, and it costs less to operate it. And as you look at institutional groups, you'll always see them. Any property can be the right property for the right price, but we're always going to drive to that Class A. So we may buy a B property that's a little older, fix it up a little bit, sell it to somebody else, and then move that money towards the Class A. That's been our model as we work through really the cycles of real estate. As I said, we've been open for 21 years. So we were around from 04 to 08. We managed through the 08 financial crisis. In fact, we grew sixfold as a company from managing 6,600 units that we help people buy to 36,000. And we did it because we operated through that. We said, you guys, everybody, if we have the ability here, we can operate through this. We infused money in some of the deals where the owners didn't have it. We actually got through that cycle and came out on the other side, and those people are making money again. And that's what an operator makes the difference with. That's who we are as a partner, as a sponsor, as somebody that's got the history of being able to do that. We look at the type of quality of asset that we have and tenants that we have in there. We also look at supply. So this graph right here looks from 1968 really to 2025. I would take you from 1968 to 2008. This is the supply. This means how many of houses were delivered to the US as a single unit. Gray is single family and orange is multifamily, meaning apartments, what we do. The average was 1,546,000 per year. New homes. That's actually what the country needs per year. If you look from 08 to 2025, it's averaged 1,072,000. That's crept up a little bit from where it was, but that's almost 500,000 short, right, of what we needed. That, 16 years of that, 17 years of that, that's almost 8 million homes you'd be short. Now it caught up a little bit, you can see in there from what it is. But you look at that supply, and we are short in the country of housing. And most of you guys probably know this anecdotally, right? I mean, there's a ton of people out there that can't afford to buy a home. The rents went through the roof from 2020 to 2022. You look at how to buy a house today, and it's much more expensive than it ever was. And so supply, meaning what's delivered to the market finished as a product, we've seen grow over the years, but there's a big gap between what we need and what we built over the last 17 years. Now we look at when did things start getting built, right? So this graph is the orange is kind of the year-over-year percentage change of when somebody starts a new project, meaning we're breaking ground, we're going to build an apartment or a house, and we're going to deliver that. It takes me 2 years to build an apartment complex and then start to lease it up. And the lease up usually takes about a year. So you're looking at it like a 2-3 year time range from start to finish. The last graph showed us when things were finished. This graph is showing us what kind of startups we are. And if you follow this to third and fourth quarter of 2022, you can see we kind of have the peak of where we were starting new developments. And then what happened? Anybody know what happened in 2022?
Interest rates.
Well, 2020 was COVID. 2022 was when we had interest rates spike. The Fed raised rates faster than he ever has in the history of Fed. Ever. 16 months went from 0 to 5%. When you see that type of change in interest rates, it affects how we value our real estate because we are an appraised value. We look at the income generated off the real estate and we appraise it that way. It's different than your single family. It all goes through the intrinsic values of what that is in there. And if interest rates go up, the values of those change. There's something called a cap rate that we use in there. I won't get too far into that because it's getting into the weeds, but that affects that change. And what we saw in 2022 when interest rates went up, banks said, I'm not going to loan to you as much. because I have risk in there. People don't really talk about what happened to the banking industry. We all remember Silicon Valley Bank and one or two others that blew up in there. Well, they just kind of shrink in. Banks don't take risk, right? The Fed quietly put $400 billion into that to keep them liquid because they were buying long-term treasuries, and they just stopped lending. In fact, in 2023, when we tried to get a loan to do a new construction, we could only get 42% of the cost to build it. Well, normally when you build something, you need 65, maybe 70% of the cost as a loan before you start that. And so people just stopped doing startups. They didn't know what the value was going to be at the end. Right now, today, I can probably buy something for about 15% less than it cost me to build it. So you see up here with 32% less new startups per year starting in 2022. Why? What did I tell you it takes to build something? It's about 2 to 3 years, right? So right now, everything that started in 2022, where we're at a peak, got finished being built at the end of last year, kind of third and fourth quarter of 23 and 24. Now those things are being leased up. And this drop in new starts is what's going to drive rents and values for us. There's not going to be the supply we need. And this may not be a great aspect for the youth of America that's coming into, the home space, but you're going to see those rents go up more. You're going to see values there. And I don't need interest rates to come down for us to look at that. That is going to naturally happen in that aspect of it. And that's what we're looking at going forward. We're really in what's the next cycle of real estate. So if you look at this is a commercial price property index pricing, right? So focused on orange since it's apartments, gray is office, yellow is industrial, green is retail. But if you follow the orange, what I always like to show people is think of these as the pricing. This is the cost of it, right? You kind of see the 08 financial crisis. Everybody remembers from 04, kind of 02 to 08, housing prices went crazy up. People were going to get priced out of a house. You can't buy into it. You got to get into these things. Then we had the 08 financial crisis and everything went down. And I will tell you, that market in 08, if you remember it, was a hard time. Great big financial institutions were going down. Rents were coming down for one of the first times really we've seen in a long, long time. And it felt like the world was ending. You can see the shift in values came down right there. We talked about it in the last one. You stopped seeing supply kind of go there. And then from 08 to 2020, you had a steady growth. You had two things that happened. Interest rates were coming down and rents were going up. Those are the two biggest factors that we can see happening there. And you had great growth. It was a terrific time for real estate. 2020 happens in COVID, which you were mentioning, right? And we had kind of this forced real estate cycle that everything got froze because we couldn't raise rents. We couldn't do different things. It depended upon what you own. By the way, Class A, my apartments, we collected 97.8% of our rents during COVID. It's a fantastic number. I can't tell you how many anecdotal stories I have of people that owned 4plexes and 10plexes that were like, I've got people that's not paying their rents. It's part of the reason you like working with groups like us, because we can have that difference in there. And when you have the Class A, asset, the tenant in there still wants to buy a house in the future. They have goals for things. They just turn on their laptops and go to work during that time. Back to here, you get from 2020 to 2022, nobody expected it. We had a doubling in real estate. So 2008 to 2020 is one cycle, 2020 to 2022 is another. And then what happens? The Fed raises rates. Why? Because we had inflation going through the roof. The reality is apartments are one of the best hedges against inflation that you can invest in. Earlier, you heard Kelly talking about risk and inflation and what do we do to put that in there? Real estate, specifically apartments, right? Because every year we get to check our rents. Every year we get to say, what is our rent going to be? And if inflation is going up, our rents are going to go up with that. And I will tell you, it's not a great thing, but we saw the most rent growth we've ever seen. There were points we saw 15 and 20% rent growth. Some of that was a little bit of catch up, but some of it was just bringing it to market, right? And unfortunately for some people, that meant the rents went up in a way that became a little bit harder to manage. But the reality is that's what happened. When the Fed raised those rates, you can see this drop that occurred. What I think is interesting about this, what I hope most people get away from this slide, is if you look at 2008, you see that peak where people are saying you're being priced out of stuff. Real estate's at a great peak. And you follow me over to the next correction in 2022. That bottom is higher than that top. If you stayed invested, if you stayed in the game, you still wound up in a better spot. Now, it takes good quality operators that have the right leverage, who have experience to get through these type of things to make sure the investments you are in a good spot. But that's what we do. And so I always look at this graph and say, okay, I can understand this. And what it tells me is stay in the game, right? Stay invested in that type of stuff. And apartments for us is where we focus. It's what's going to continue to do really well. We do it 3 different ways. I talked about this earlier. We have operating properties. We have real estate related investments, which is us lending to developers. And we have the ground up development on it. So to give you an example of an operating property, this is called the Market Highland Park. It's in Tampa, Florida. We bought this asset in 2017. It was built in 2015. Really nice Class A place. It's got dog parks, it's got high-end cabinetry, stainless steel appliances, a gym in there that's probably better than most of our memberships have to it. Dog parks, because everybody wants to have a dog, right? Get your little buddy in there. And reality is these are great Class A apartments that we have in this stuff. We'll either buy it, we'll build it, and operate it. That's really how we get to them, right? When we look at development, this is an asset called Sugarmont Apartments. It's in Salt Lake City, Utah. This is one of our flagship assets that we built. Really nice, high quality apartment. You can see here, you've got, kind of some of these townhouses on the left of it. That's part of it, a nice pool. This place was one of the top growing markets in the US. We actually just sold this asset last month, right? And did really, really well with it. We're recycling some of that money into those real estate related investments that we talked about, where we're seeing a higher return in that type of stuff. We're having that there. The way my fund is structured, we price it out monthly. Every month we do an appraisal of all our assets. Every month we offer liquidity to all of our investors. They can get out of it. So we need to make sure that we have liquidity on hand, that we have the pricing on hand for our investors to be able to get in and get out on that stuff. And we make sure we have that stuff. Today, after the sale of this and some other things, we have about $160 million of cash that we're going to deploy into new investments. Right now, we're kind of at the bottom of this market. This is a great time to be buying things. And we have a lot of opportunity in front of us to do that. Then we have the real estate related investments. This is what we just talked about. We're pushing some more money into. This is an example of where we invested $10 million as a mezzanine loan, a middle loan between the bank and the developer, right? That we're getting a 14.5% yield on. It's 3 years with a one year extension to it. If they pay us off early, they have to pay us all the interest, a 1.4 multiple, right? So we have safeguards in there. If somehow if they were going to default on the bank, we would take it over. If they default on us, we take it over. And only one time in the 21 years of us doing it have we had to do that. And it's turned out as a really solid situation for us. This is an example of kind of ones that we brought to fruition. The bottom left, 805 Riverfront is the one asset that we had to take over. It started out as an investment deal. Banks were forcing developers to reserve capital for lending because the interest rates went up in 2023. That developer had finished building it all the way and just didn't have the capital to reserve it. And so we said, are you sure? Want to try to come up? And he just couldn't. So we took that asset over. We finished leasing it up. It was barely leased up at all. It's now at 95% leased up, I believe is where that one is right now. And we got it at like 103 from the developer. It's worth about 114 right now. So that's a great process that we've done through. But all the rest of these are great examples of, the yields, like you can see up here, used to be in the 12s. Now you're seeing 16s and 13s, and the IRRs are in the 19s and 20s because of the way things worked out for us. It's a great way for us to invest in that. So looking at kind of historical returns in real estate in general, who's renting, what's happening with affordability and housing, and what's going on with apartments, I think is critical to what we look at. I look at the different asset classes. Multifamily has been one of the strongest performing asset classes out there when you look at industrial, retail, office, and kind of what the average is, right? It's above the average. Now, industrial, you can see, has done really well. And why is that? Because everybody buys everything on Amazon, right? And you have a lot of that type of growth through there. There's some supply stuff that's happened through that. I think we've seen a lot of supply come onto it. I still think industrial is a good place to be, but I think multifamily is a better hedge against inflation because we check those rents every year. And because I'm biased, that's what we do. Talking about inflation, you look at this, from 1990 to 2024, we've outperformed inflation by 5.5% in apartments. And during COVID and the hard period part of it, 21.48% exceeded inflation. That is what you want to see as you're looking to hedge that stuff, right? Who's renting from us? Well, we've talked a lot over the years about the millennials. There's also the Gen Z generation right behind them. I think what's most important is when you look at the young professionals of America, people 24 to 42 years old, right? Those are the people that are really renting from us. And they're starting families later in life, right? People aren't getting married till in their late 20s and 30s. They're not having kids until that period of time. The idea of owning a home is a little less important in a lot of cases. In fact, experiences, traveling the world that we were just talking about, in many cases, a selfie in Malaysia at the top of a hill is more important than owning a home that early in life. And also the affordability of it, right? I mean, today to buy a home, you're looking at $500,000 when that used to be exceedingly high to buy a home, right? And that's just where we are. The ability to get that down payment to move into that stuff is different. And all the other factors that they do in life has people renting longer. I think for everybody that refinanced a home before 2022, they're probably somewhere in the 3%. People don't realize it, but that is the best asset they have. And for many of them, they're locked into that home. I was talking to a nurse that was helping me out the other day with my son, actually. And she said, I'm stuck in this house. I've got a 1-bedroom apartment. We had a kid. We thought, we were going to move into this to be a stepping stone. She's like, geez, I can't afford the new interest rate, let alone the fact that the house is, if I wanted to buy another house, it's like double that. And we're about to have another kid. We're kind of stuck in this apartment on there, but we can't get out of it because it's so affordable. And there's a lot of people in America, maybe not that drastic of a situation, but they moved into what they thought was their first time home, or they stepped up a little bit, and they're going to be there for a lot longer than you think. They're just not going to sell those homes. That's going to drive people that were living in apartments and thought they were going to buy a house to rent longer. And that's what we provide. So looking at Cottonwood, this is where we are today. This is actually every month, as I mentioned, we do our price. This shows our price at $11.54. Our price today is actually $11.56. As of yesterday, we've gone up a couple pennies in there. You're starting to see the values come up. As you look on the right-hand side, you see a lot of negative numbers. This is because we started this fund out in December of 2018 at $10 a share. It grew to $20.72. As we saw that interest rate change that we talked about in 22, we had the correction. We price out every month through appraisals of what our assets are. We've kind of hit the valley of that new correction. And you're starting to see that price trickle back up. My yield in this, as you look at this, is somewhere in the 5.45 to 6% range. As you're looking at it, you expect to see growth. I expect for this fund to do anywhere from an 8 to 12% annualized total return between the income that you're getting as well as the growth in there. What's important is when you look at income from real estate, we depreciate the asset itself. And so the income that comes to you is tax advantaged. It feels like you're getting your money back and reduces your cost basis of what you invested. You don't pay tax until you sell it and you pick it up as capital gains. And for almost everyone, ordinary income tax is higher than the capital gains tax. And it looks like that's going to stay in place for the foregoing future. So we love, kind of that tax yield because it's advantage to us. This is going through what we talked about, right? Price started at $10 a share. You see it went up. Then we kind of came down. We've seen this correction. It's kind of leveled out here. What I'll point out to you guys is it used to be 50 cents a share was our distribution rate. Today it's 73 cents a share. We never dropped that distribution rate. The income that's coming off of there grew 45%, and we've been able to maintain that for our investors. We think that's really important because there's a lot of people that use that income to supply their retirement, right? They want that tax advantage from it. They want to be able to use it. Some people don't. They reinvest it, and it's a kind of more of a growth vehicle to them. But for us, we thought that was really important to maintain it, especially while we saw the price coming down, right? Now, that's something we have the right to adjust that if we wanted to. We just have maintained it for now. And I think we're in a great opportunity. Today is probably one of the best times ever to really start looking at real estate again, because these things last 8 to 12 years. You may get 8 cycles in your lifetime of real estate, right? And so we're going to see the next one start today. This is screaming opportunity. Here's what we look like. We're a $2.3 billion fund. We're raising $1 billion. Well, this is actually a perpetual fund. This is meant to be around for decades to come, right? As I mentioned earlier, we priced it out every month. So every month we have a third-party group come and appraise our real estate, the debt that we have on that real estate, and all our operating assets. And they tell us what our price is. It's definitely third party, arm's length transaction when you're looking at that. We decide the distribution rate based off of the fundamentals of the real estate and what we think it can bear. And that gets you that total return of what we think will be 8 to 12% between the growth and the income together. We hope that you look at real estate as a long-term investment. You shouldn't get into real estate unless you have somewhere between a 5 and 7 and 10 year time horizon. I will tell you, if you buy this product, for the first year you can liquidate, there's a 5% penalty. If after 1 year of owning it, there's no penalties. You can liquidate without any type of penalty on it. We have caveats because it's real estate that up to 2% of the total fund value can liquidate any month. If we go above that, we have to prorate what you get back and you go to the next month. Thankfully, we've never hit that proration. We've always been able to honor every single liquidity request that we've ever got. We've always paid every distribution that we've ever set. We've never lowered our distributions as we run through this. And that's something we are extremely proud of. It takes some maneuvering to be able to offer that to your investors. It takes some understanding of the real estate and the times that are coming to be able to do that. But we've done it really, really well. This pays out a 1099, so very simple tax-wise on it. And that you'll see that shelter, that income won't look like income for you. It'll look like a return on cost basis until you liquidate it. You wouldn't have to pay those taxes on it. This is what we look like, right? $2.3 billion worth of real estate, 21 years of history of what we're doing. I've talked to you today about the common equity. It's where you can invest with us. It's a perpetual fund. You know, you may add some to it. You may take some off during times based on what you need. You may own it kind of like a mutual fund, but it's private real estate, right? That's one way to invest with us. We also offer 2 other investments that if you're interested in, you can sit with Kelly. So what I talked to you today about is common equity. It's got growth and income to it. We also have what's called preferred stock. Preferred stock, the way we structure it is something open to accredited investors, but one of them is income only. So if you like the idea of real estate, you want a security, you don't want volatility, you can buy this, have a stock stay stagnant, we'll pay you a distribution rate, 6.5%. And then after 5.5 years, you get your money back. It has a little escalator at the end. We have another preferred stock where if you want to get into the real estate, but you want some security for the next 2 years because you aren't quite sure yet, we have a convertible preferred stock that pays an 8%. There's different ways to access our portfolio. What I would urge you is if you like what we've heard today, if you like apartments and the concept of that, you know, make an appointment with Kelly, sit down and say, what makes sense for me? Understand, so she can customize like that, which what she talked about earlier, right? Understanding what your situation is and saying, this is what would make the most sense for you. So with that, any questions? I don't know if we have stuff online, anything else?
Risk.
Risk? Everything's got risk. I'm a 50% levered real estate fund. So you have to look at that stuff. In the common equity, I mean, I just showed you a market where it can go down, right? We have a great history of that growing up. I didn't point it out, but if you invested originally with us, even with that correction, you were still getting a 7 to 8% total return. That is phenomenal. Going through the biggest correction since World War II of real estate, you still got a 7 to 8% total return. That's a pretty good number on there. And then if you want to mitigate some of that risk, we have the 2 other products, the preferreds.
All right, I have some questions for you. Okay, what is the yield and how much is tax advantaged?
Okay, so in the common equity, the yield right now today would be we're doing it, it's a, I had it back there. I want to say it's like a 6 on there. And the tax advantages on it is 6.07.
Okay.
And the tax advantages on it are 100% of it's been sheltered. So in the common equity, we expect that it'll all look like a return of principal and that you'll reduce your cost basis as you carry it forward. You won't pay tax until you sell it, and then you pick it up as capital gains. In our preferred stocks, we think half of it will be sheltered, half of it will come to you as ordinary income tax as an average of that. So also some tax advantages, which means it has a little bit of better value to you in a non-qualified, I mean, not a retirement account, but qualified money is great. Your retirement accounts is a great spot for this because that's where a lot of people's long-term money is. And then you just use the total shelter from the retirement account.
Okay. Where are most of your apartments? It looked like there was a lot in Salt Lake City. Do you have most of them there?
I don't have most of them there. We had, let's see if I can just, without making the whole world sick real quick, we'll go right to, I should have that at them. There we go, right here. So you can see the concentration levels. We had an 18.5% concentration level in Salt Lake City. We were building into that, so you were seeing that kind of grow there. As I mentioned, we just sold 2 assets out of there, Broadway and Sugarmont. So that's bringing down that exposure to Salt Lake City. It's part of another reason why we sold those 2 assets. We had anticipated buying into other markets as we were going there. Obviously, we didn't know 2022 was going to occur, so that stopped a little bit of the growth of the company. We've now leveled out some of that, but we still think Salt Lake City is a great market to be in. This is a great example of where we're located. And you'll see us kind of big up. If you're seeing smaller numbers in certain areas other than Portland, Oregon, we don't expect to expand there. You'll see some of those areas grow.
Terrific. Okay, what is the minimum?
$2,500 for our common stock, and then $25,000 in our preferreds.
Okay. How long should I invest for? How liquid is the investment?
Great question. You should get into real estate investments with the idea of a little bit longer term hold. So as I said earlier, have the idea that you don't need the money you're putting into it for a specific event for at least 5 years. Right now, if you get into a scenario where you need it because life changes and that happens, as I mentioned, we have liquidity. Every month you can actually liquidate your whole investment in our common equity. As long as we haven't hit those caps, you can get that out of there. After you own it for 1 year, there's no penalty for that. With the preferred investments, they have a different life schedule to them. There's something you want to sit down with. The one that's the most simple has about a 5.5 year hold. You do have the ability to get out with a sliding surrender schedule. With the convertible one, it's really a 2 years, then you're liquid, and 3 years before liquid without any penalty. So a little shorter term on that side.
Terrific.
Great.
Thank you, Saul.
Thank you.
It was
Thank
great.
You,
really
Thanks, everybody.
great.
Appreciate you.
Okay, I'll go through my last slides here. Oops, I gotta go.
All right.
That's okay. Slides, yes, slides. Okay, whoops. Oops, what'd I do? Now I can't go back. Maybe Hannah can fix it. I think I pressed the wrong thing on this thing.
I'll take
There we go. Okay, so Saul, thank you again. I love real estate. I love apartments. Fabulous, as he just explained to you all. I love what they offer. We have quite a few other seminars coming your way. So like I said, next week we have our roundtable with our estate planning attorney and our tax CPA. Love them. We're all going to sit up here and have questions. It's going to be really great. We did it once before a number of months ago. Very beneficial for our clients. We also have a webinar we're going to do on how to create income in retirement. That's July 8th. So that'll be a Zoom only, no in-person. Sorry, everybody in the room here. It's not going to be in person, but we're going to Zoom that. How to create income in retirement. What do you use to create income in retirement? And even my high net worth people don't know how to do that. They don't know how to take their assets, their 401ks, their trust accounts, different 1031 exchanges they might have, how to create more income off of that. I just had a client do a large 1031 exchange with me, and I'm creating much more income for him off of his current assets than the rents he was getting. So when you run the numbers, a lot of times that can be very beneficial for you to create income. So the July 8th webinar will be on how to create income in retirement as well. And then of course our summer party, that's coming up July 26th. It's gonna be so fun. It's a golf theme. So we have lots of events planned and fun things happening that day. So by all means come. Now you have to be a client to come for that. But then we have many more after that. For the rest of this year, we have different kinds of real estate. We have oil and gas programs we're going to talk about, all sorts of things. So check the website, check under the events tab. That will be on there. And so again, if you're new to me, I like our first meeting to be in person. I want to get to know you. I want you to get to know me too. I want to make sure I can bring to the table what you're looking for. I can do Zoom meetings and phone calls as well, but I prefer it to be in person. And I do go down to Anaheim every Friday and meet with my LA and Orange County folks there. Tends to be a nice place to meet everybody. Or you can come to my Santa Barbara office here and meet Hannah and Carter and Christian too, and all the rest of my staff. So again, thank you for joining us. We appreciate it. It's been great having you here. We love doing these seminars. We really do. So make sure you know when the next one is, what might be of interest to you. Keep checking back the website because again, we have different topics all the time. So again, thank you everybody. We really appreciate it, and have a good evening.
Thank you.
Okay, so everybody in the room, fill out your evaluation form, and we have prizes we're going to give out. Thank you. Okay, thank you.